This podcast is sponsored by AlphaSense. Let me tell you a story. A few years ago, I was looking at a company that offered discount coupons, and I couldn't figure out, they had a really good product, and I couldn't figure out why it wasn't taken off. And then I was doing an expert call, and I was talking to someone, and I said, I can't figure out why this company's product isn't taken off. And he said, are you aware of the loophole issues? And theoretically, you could use this company's coupon plus like 3 other coupons. And if you really search and put them all in the right order at the right time, you could get products for like 99% off, right? But doing it would be really time consuming and kind of limited. Like, who wants to get ketchup for 10 cents? Cool. You get one. It took you 2 hours. What was the point? And I told him that, and he said, you don't get it. This has happened before. A few years ago, it happened with the jar of mayonnaise, and you could get a jar of mayonnaise. I don't remember if it was for a penny or for a dime, but it happened, and people were driving in from out of state. People were filling up their garages with mayonnaise, and the company took a huge bath because guess what? People will buy 500 jars of mayonnaise if it's available for basically free. And is that a weird insight? Yes, but it explained why advertisers were so hesitant to use this company's product. And it's the type of insight that you can't get without expert interviews. No management team is going to tell you about that mayonnaise problem. You're never really going to be able to find it for yourself. You need people who've been in the trenches, experts, to tell you about that. And again, yes, it's a funny story, but it's the type of insights and power that you can only get from expert networks. AlphaSense is my favorite expert network. Now that they've bought Tegus, over 150,000 transcripts with 6,000 more going up every time. Extensive coverage of every public and private company. I'm a happy customer. They've been a long-time sponsor, and I'm really thrilled to have them. Go to alphasense.com/YAVP. That's alpha-sense.com/YAVP, or follow the link in the show notes to start your free trial. All right. Hello and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could rate, subscribe, review wherever you're watching or listening to it. With me today, I'm happy to have on Sahm Adrangi, right? Is that how you say it?
That is, yep.
Nailed it. Founder of Kerrisdale Capital. Sahm, how's it going?
Good. Long time viewer, first time guest, but yeah, I mean, I love the work that you do on some of the names. It's just great to have a podcast that focuses on specific names as opposed to, just sort of more general stuff. So.
Well, I really appreciate that. I don't know, and it doesn't matter. You probably don't remember. I interviewed with you like 12 years ago when I was a fresh-faced McKinsey consultant and stuff. So this is the first time I've ever had someone on who I interviewed with, actually, which is just kind of funny background. It was like
that was my strategy back in the day. I think I interviewed everyone.
I think it was like a post consulting, like you were clear. It was like 1 year deep dive consulting into an industry. It would have been fun. I don't think it would have been good fit. You definitely passed on me, but funny history. Anyway, start this podcast same way I start every podcast. Nothing on this podcast is investing advice. Always true, particularly true today. When you have Sahm on, sometimes you might have to say that because it might be a short idea, but this is actually a long idea. But it is an international stock, US listed, but their main subsidiary, is international. So keep in mind, carries extra risk, heightened risk, not financial advice. Consult a financial advisor, do your own work. Sahm, the company is ACMR Research. The ticker is ACMR. You have put a lot of stuff into the public domain, which as somebody prepping for a podcast, I appreciate. I think it's a fascinating thesis, and I'll just toss it over to you. What is ACMR and why are they so interesting?
Sure. So ACMR is a wafer fabrication equipment company. These are businesses that make the tools that semiconductor fabrication plants or fabs use to make chips. So TSMC operates fabs, Samsung operates fabs, Global Foundries operates fabs. And the tools they purchase to make the chips in these fabs are sold by WFE companies. And the largest of the global WFE companies are Applied Materials, Lam Research. Those are starting to become household names, KLA. ASML in the Netherlands is a big one. And then there's a bunch in Japan. So Tokyo Electron, Hitachi, Nikon, Screen. And then there are smaller cap WFE makers like Acellus, Camtech, Nova, Onto, Vico, and so on. And then, one thing I want to mention before we talk about ACM in particular is just, these bigger platform companies are great businesses. These are stocks you can buy and hold for the next 30 years. And I'm pretty sure you can be confident you'll generate an attractive IRR over the long term. Lam was actually our largest holding at the bottom of the market in October 2022. The sector was getting hit hard because of concerns around cyclicality and the US government's attempts to restrict sales to China. And so the stocks got to pretty low valuations. But one of the reasons that, when the market was panicking, you could get the confidence to own something like that is because the sector lends itself to just a small number of players and all these oligopolies across each individual tool. So basically, the companies have great competitive advantages. And the reason is because there's a limited number of fabs out there, and then there's a really limited number of operators of bleeding edge fabs. And these fabs are always working hard to try to build more advanced, more cutting edge chips. And to make more advanced chips, they need to operate more advanced tools. And so the fabs are working hand in hand with the tool makers to progress the tools. So there's a very symbiotic relationships between the fabs and the WFE makers. And that makes it hard for new entrants to break into the field because there's real costs to a TSMC to qualify a new tool, rip out an incumbent tool, and replace the incumbent with a new tool. So instead, making the tools more cutting edge is the priority, and taking the risks with bringing a new tool is just not worth it. And it makes the fabs less efficient to have multiple tools for the same process step, and you have to train staff, et cetera. And so when you look at across each of these tools, they're like little oligopolies. And through consolidation, the platform companies have consolidated a number of them. And so when you look at LRCX and AMAT and KLA, you'll see they trade at pretty attractive multiples. And that's just because you can be confident that, these companies are going to be around 20, 30 years from now, and they'll have attractive steady state margins down the line, at the end of the growth. And so that's pertinent for ACM because I think the Chinese WFE players benefit from some of these same competitive advantages that the international guys do. And there's actually a really good write-up on VIC in October 2021 on LRCX and SOXX that breaks down why semi-cap companies are attractive. So I'd encourage anyone newer to the industry to read those two write-ups. But at the end of the day, it has to do with the WFE industry being naturally oligopolistic. And
can I ask you a question on that? And for those who don't know, Kerrisdale has published a report on ACMR, which is great. I'll include a link to that in the show notes. And Vic, valueinvestorsclub.com, where I don't want to break pseudonymity, but I think you could find both of our handles on there pretty quickly. But that's what he's referring to on the write-up. Just a quick question on there. You end your report, which is comprehensive and I liked, and you say, hey, if you can invest in Lam Research or Applied Materials back in 1995, this is effectively doing that, right? You'd obviously do that. I mean, the stocks are like 50 baggers over the past 25 to 30 years. And I love that thesis, but I guess one quick question on ACMR. They have managed to kind of from a standing start over the past 15 years, take significant share on the Chinese market. And obviously you think they have got some chance of taking share in even the domestic international markets. Isn't the fact that, yes, with some government support, but isn't the fact that they're managing to break in here from a standing start over 10, 15 years proof that you can break into these oligopolistic markets?
Well, they're able to break into it. So if you look at their sales, all their sales come from China. And they have viable products and they're trying to sell into Intel and SK Hynix. But that ramp up has been slower. And it's because, Intel and SK Hynix have to make that decision on, are they going to want to replace their cleaning tool or their electrochemical plating tool, the incumbent, with ACMRs. And so the hurdle that ACMR needs to jump to be able to break into those fabs is much higher. Whereas in China, the Chinese fabs are mandated to go with a Chinese tool maker if it's remotely competitive. And so they've been able to go from $30 million of revenue in 2016 to 2025 guidance of $850 to $950 million, basically $1 billion of revenue, because they're getting preferential treatment. And that's why the Chinese players are trading at 8 times revenue, because this preferential treatment is allowing new tool makers to develop, basically incubated within China, and then the second leg of the thesis after all the white space is grown into in China is that these guys are going to be able to become a second source and third source internationally. And their ability to, develop tools that are competitive is because of sort of this incubation that they're receiving in China that really can't happen very easily outside of China. And so, today it would be hard for an Applied Materials or a Lam Research to develop, outside of like individual tools here and there, outside of China. But in China, you're sort of seeing, platform WFE companies develop because of the preferential treatment they're getting.
There's a lot to talk about here. There's a special situation angle, an event angle, political angles, all sorts of stuff. But I just want to start the podcast the same way I try to start every podcast. The market's a competitive place. It's not lost on people that Lam, Applied Materials, all these are great businesses. And ACMR, I mean, we've got Vic Access. It's been a popular pitch for several years on a lot of the things, the Chinese support, the great business, all this. Kind of been flat over the past 5 years. So I guess I'd ask, what are you seeing that the market is kind of missing and has ignored for the past 5 years?
Yeah, I never really know how to answer that question. I mean, ultimately, I just try to look at companies, just understand the valuation, to value them, the present value of their future discounted cash flows, and when they're trading at a discount to that, just own them based on that discounted valuation. Getting into the market's head around why something trades low. I mean, sometimes things trade low just because a few people are liquidating it. In this instance, it is a little bit more straightforward. The company is U.S. listed, operating a Chinese semi-cap company. I'm sort of the view that most Chinese companies shouldn't be listed in the U.S. just generally. I mean, I think it's better if your operations are in a given country to be listed in a jurisdiction that reflects those operations. And so, but I think in this specific instance, you've got the U.S. government that's taking actions to try to restrict the growth of China's semiconductor industry, and by virtue of that, the WFE sector within China. And so it sort of doesn't really make sense for a company operating in that sector to be listed in the U.S. And I think I think ultimately one day, the shareholder base of ACMR will ultimately be, whether it's in Hong Kong, whether the company goes private and relists in Asia, I think ultimately you'll have a shareholder base that aligns with the underlying operations. And sort of this discount won't really have a justification to exist anymore. I mean, the only real argument that resonates with me on why this discount exists is just because of the mismatch between the shareholder base and the listing and the underlying company. But, that can be fixed. And in advance of that being fixed, I think the dramatic discount that currently exists will correct to some degree, anticipating that.
And the discount, there are actually two discounts you could talk about, right? There's one, the discount ACMR trades at to most peers. ACMR, if I'm remembering correctly, would be like pretty top tier in terms of margins, growth, a lot of things, but they trade pretty bottom tier in terms of multiple. That's one discount you could be talking about. The other discount you could be talking about, and one of the reason I think a lot of event people find this interesting is ACMR is the US listed company that we're talking about. They own 82% of ACMS, which is Shanghai listed, I believe, or is it Hong Kong? I can't remember which one.
Shanghai listed. No,
Shanghai listed.
China A shares. That's a big part of the story, that it's A shares versus Hong Kong.
And the Shanghai listed shares of ACMS that ACMR owns, they own 82% of them. If you kind of did a fair value of them, it'd be worth about 5 times ACMR's market cap. So I'm not sure which discount you're talking about. I'm sure we'll talk about them, but just so listeners know, there are 2 discounts that we're talking about when you talk about ACMR.
Yeah, and we in the report we have this chart like page 6 or 7 that lays out 5 valuation methodologies. So like when we did a DCF, because of the revenue growth and the attractive margins at a steady state basis, that spat out around $70. On a comparable companies analysis, whether you compare it to the US listed WFE companies, large cap or small cap, the Japanese guys or the Chinese guys, you get a range from anywhere from like $60 to $110. And then the ACMS valuation implies around $75, $73 per share for ACMR. So it's trading at, a north of a 50% discount, more like 60 to 75% discount across whatever valuation methodology you use. And I think all these valuation methodologies are pretty reasonable. We also took like a 2028 EPS estimate, applied a 30 times PE multiple, which I think is reasonable given the growth and margins here, discounted that to today, and you get like $63 per share there. So, $23 is just way below any sort of valuation methodology you come up with.
Look, I know I'm not breaking new ground because I listened to, I'm going to say 75% of the, you guys did a Twitter space, which I thought was excellent. And if I can kiss your butt for a second, I love how you came out and right at the front, you said, hey, this is a big position for us. I want to know if you have different views. Here's my cell phone. Here's my email, like all this. Because I have people who come on here and I'm like, hey, how can people contact you? And they're like, oh, the plebeians can't contact me about this position. I love how you're just like, reach out to me because you clearly want to learn more. And I really appreciate that. But I'm not breaking new ground with this question here. How much of ACMR, looking at it, we've been talking business, fundamentals, multiples, Lamb research correlations. How much of it is a business question versus Kerrisdale is no stranger to Chinese, U.S. listed Chinese companies. How much should we be talking about politics in two forms? A, everybody knows that U.S. Chinese listed companies, there is a lot of fraud among them, and I don't use that word lightly, but that has been proven out. That's one risk. And B, the second risk would be, hey, geopolitics in terms of what if China changes their support for the WFE, national industry and that sort of stuff. So how much should we really be thinking about business versus, I think those are kind of the two headline: politics, market trends, regulatory stuff.
Sure. So on the politics side of things, we're trying to trigger a narrative change here. So this stock traded down from, I think, around the $19 range down to $15 in November and December. And it was on the back of the company getting added to the entity list, which is sort of just a negative headline in terms of this company's positioning vis-a-vis U.S.-China tensions around the growth of China's semiconductor industry. And the narrative change we're trying to trigger is that all of these headlines that you see around the U.S. trying to restrict China's growth in the semiconductor sector is actually good for ACMR. This is a direct beneficiary of the entity list existing. This is a direct beneficiary of Trump if you think Trump's going to be tougher on China. The tougher the U.S. is on China in the semiconductor sector, the more China's going to double down on incubating and developing its domestic tool makers, of which ACMR is the third largest one. And so historically, at least before our report, when you sort of saw some of these rules come out, you'd see ACMR trade down. In reality, it really shouldn't. It getting added to the entity list ultimately isn't going to impact its operations that much. And we can talk a little bit more about that later on. But, a lot of the rules that that Biden has been passing to try to prevent the growth of China's semi-sector, if you look at the numbers, they just haven't really worked. There's a number of workarounds, and China is progressing. And when ACMR gave its guidance in January, middle of January, it wasn't all that different from what consensus had before they got added to the entity list. So that's on the politics side. On the fraud side of things, what's given us conviction on this name is channel checks. And back when we were exposing Chinese frauds back in 2011, 2012, a lot of the ways in which we were doing that was through channel checks back then, checking facilities, talking to customers. Back when you had U.S. listed Chinese reverse mergers, there were some, pretty obvious signs of fraud. Like I remember Orient Paper would change its top 10 customers every year. Like every year be a new top 10 customers. And you're like, in the real world, that can't exist. But
my favorite was the John Hempton one, where he's like, "Hey, if you read this 10K or 20F correctly, they would own like all of the forests in the entire world to match the kind of the numbers they were doing." Do you think back to those days and think, man, it was like shooting fish in the barrel then?
Yeah, I remember I was talking with one short activist back then, and we're like, there's no way this can last. This was just too easy. And then, it didn't last. And, there are still reports out there that come out on, Hong Kong listed companies. But we started doing some Hong Kong listed companies in 2012 and 2013. And after a while, we just sort of came to the conclusion that, yes, there is fraud around the edges, but you just sort of didn't see as much of the totally obvious fraud as you saw back with the U.S. listed reverse merger frauds. And so when we think about ACMR, our channel checks have just come back that these guys are the number one player in cleaning within China, that their ECP product also is innovative. And there's been a lot of color that's come back that sort of has indicated that they're less of a copycat WP player versus some of the other companies, that they've had some novel patents come out and that there is a strong core team of engineers coming up with new technology. But ultimately, even if they are very much on the copycat side, it's still very bullish for the overall story. The ability of these companies to reverse engineer tools from foreign players in maybe not, in litho or the most sophisticated tools within the semi value chain within the WP sector, but maybe sort of the bottom half of less sophisticated tools and reverse engineer them, make competitive tools, and be able to just get market share within China and then ultimately become a second source and a third source internationally. There's just so much growth available, to these companies, and ACMR with the third largest one, it's exciting. And so we're just focused really on the top line. And if they're selling their tools into the fabs, and you're sort of getting good color that these tools are competitive, the revenue is going to grow. And then intuitively, as we were discussing about, these types of businesses, they should have attractive cash flow margins down the line. And so that takes some of the fraud risk out there because, for instance, if they've got sales agents that are skimming some profit off the top, today, well, the profit today just isn't as important as are they building competitive tools and where are they going to be 5, 10, 15 years from now? And that part of the story is really checked out.
This podcast is sponsored by AlphaSense. If you're unfamiliar with AlphaSense, it's a market intelligence platform with the world's premier library of proprietary expert insights. For years now, I've used Tegus for their expert call transcript and library. And with AlphaSense acquisition, the depth and breadth of market research content available has expanded significantly. With unparalleled expert insights across 150,000 proprietary expert transcripts and growing by 6,000 per month, covering 24,000 public and private companies, comprehensive market intelligence on 450 million plus documents, including company filings, analyst research, expert interviews, and more, and AI-powered research at scale, complete with qualitative research for 5 to 10x faster with advanced generative AI. Take a free trial and see the difference for yourself. Just go to alphasense.com/YAVP. That's alpha-sense.com/YAVP, or see the link in the show notes. What about the other risk in terms of, I don't know if this is political regulatory, but when I think about Chinese companies, there's two risks. There's one, legitimate Chinese companies. There's one kind of getting alley paid where the government comes to you and says, hey, that's a really valuable asset. It's probably going to belong to us, not shareholders. And obviously that's a dated example, but I think there are ones that happen. And then the second one, which I actually think is the more relevant one here, is I have seen a lot, and these are much smaller companies, but I have seen a lot of companies that kind of have the dual listing, a US listing, a Hong Kong listing, or they see all of their peers trade in Hong Kong for 5 times the multiple that they trade at. So you get the controlling shareholder says, hey, US shareholders, our stock trades for 10. Here's $12 per share. We own enough of it to force this through. Thank you so much for your service. And then 6 months later, you see it IPO over in Asian market, and it IPOs for, if they took it out for 12, it IPOs for 50 or 60, and you say, gosh darn it, did it again. So I guess it just asks, the worry of every investor when they invest in a company that has Chinese assets, like as a minority US investor, will I ultimately get the cash flow, make a profit here?
Right. So ACMR has a dual share class structure where the CEO is voting control through the Class B shares, but he actually owns only 10% of the economic stake of the business. And so if he were to try to do a take private at a low discount, the color that we've gotten here is that the penalties would potentially be so significant on the 90% that he doesn't own, accounting for sort of the gap between the discounted valuation and what fair value would come up with, that the M&A advisors that he'd probably hire in this instance to, say, team up with a private equity firm to take the company private and ultimately relist, would strongly advise against taking the company private without pursuing a majority of the minority vote. So I think in a number of the instances where these U.S. listed Chinese companies have taken private at a low valuation, the CEO owns 50 to 80% of the company. In this instance, because his economic ownership is only 10%, and there's such clear valuation benchmarks here that you get a higher value. I mean, you've got the exact same company listed in another jurisdiction at a valuation of $73 per share compared to the sort of the $23 it's trading today. There's just a pretty decent chance that the Delaware courts would rule that, this is taken at a significant value discount. And if you don't pursue a majority of the minority vote, you're really at risk of the courts ruling against you. If you do pursue a majority of the minority vote, that makes it a lot easier to ultimately argue that you took the company private at a fair value and sort of the discount that you took it a private out relative to, say, the China shares is okay because the majority of the minority voted for it. But I think, if they have a majority of the minority vote, I just don't see the shareholders, the public shareholders here, voting in favor of, say, a $25 take private, et cetera. Now, what take private will induce a majority of the public shareholders outside of the CEO to vote in favor of this, I'm not sure, but I do think it'll be a decent premium to where it's trading at.
It becomes an interesting negotiation game theory, right? Like stocks trading the mid to low 20s, they come out with a $30 per share offer, and everybody's going to push back and say, hey, there's $70 over in Shanghai. And then you've got an interesting, like, how many people can we clip if we go to 33, 36? Like, you're not, maybe, but you're never going to get the whole 72, right? But at 71, if it was 72, everyone goes for it. It becomes an interesting negotiation. Just real quickly, when I first saw you write this up, I thought, oh, Chinese listed US Co. It's a VIE. This is actually a Delaware incorporated company, and I believe the CEO, not a U.S. citizen, but lives in the U.S. If you just want to briefly touch on that, because I do think that is kind of important just from a corporate governance angle and a few other standpoints.
Yeah, so you directly own the Chinese OpCo in this instance, which is good. You've seen capital return on some of these VIEs. I think the Huya and Douyin come to mind. But here, you don't have to sort of deal with that theoretical obstacle because it's direct ownership. And then in terms of the CEO being a U.S. citizen, the interesting backstory here is that his vision for the company historically had been to try to be a global WFE player, not just a China player. And we've heard good signs from, in terms of traction that they've had in some of their non-Chinese semi companies, customers that they're trying to sell into. And I think we're most optimistic about maybe SK Hynix there. But 5-10 years ago, given the type of patents and technology they were coming out with, that vision of being sort of a global player within the WFE landscape, was legitimate. I think just things have changed just in terms of Chinese-West relations around the semiconductor industry. And so this idea of potentially transitioning from being a U.S. company, with global ambitions to, maybe being more of an Asian company with global ambitions starts to make sense in a way that it didn't necessarily, 10 or 15 years ago when management pursued a U.S. listing. You just sort of didn't have those same tensions back then.
CFO's at the UBS conference in December, and it's not lost on the management team that they've got this huge value discrepancy where ACMS is trading for, 5x the price of ACMR. And he's basically asked a bunch of different ways, hey, why don't you guys do something to take advantage of this? And he kind of demurs. He basically says, no, hey, we're a growth company. We want to grow. And that all does make some sense to me. Like the returns and the growth here are really good. But at the same time, when you're sitting here telling me, hey, this is a great company. I see the vision. I see the outlook. It's like you can buy it at an 80% discount in the US market. It does kind of strike you as he sees it. It's not lost on him. And they're not doing anything to address this. Getting greedy, right? Management buying shares on the open market, the company buying back shares. There's lots of things they can do. And I just kind of wonder, like, it's just a strange incentive. It's a strange structure. It's strange to see. So I just want to ask you, like, why don't you think there's urgency on their end? Is that a red flag to you? Is this just a non-economic team? Like, how do you kind of think about that when there's something that seems economically rational, somebody seems to acknowledge it, and they're not doing it?
Yeah, my hope is it's just a slow process in terms of them pursuing sort of the value unlock here. For me personally, the capital return ideas out there around the value unlock just don't really resonate with me as much. Maybe they'll resonate with other shareholders, and we'd be supportive of, for instance, the company selling.
Yeah, could you give one that doesn't resonate with you?
Yeah, so I think one obvious way they could unlock value is sell 25% of ACMS, buy back the whole float of ACMR, or dividend all of that back to ACMR shareholders, and try to sort of unlock value that way. It's hard for me as a shareholder to tell a CEO who's been running this business for 30 years, sell 20% of your 20% of your enterprise, because his time horizon is probably much longer than mine. And if he wants to run it for the next 20 or 30 years, then who am I to go and tell him sell a quarter of your business just so I can generate an attractive return over the next 12 months, right?
I do hear that, but at the same time, like, well, you are a shareholder, and that does sound pretty nice.
Yeah, but I just do think that there are other paths here that don't require him to give up any more control over his company than he currently has. And so I tend to be a fan of pursuing the dual listing in Hong Kong, and aligning the shareholder base with the underlying company, versus I think there's been talk about, all right, well, they could sell a whole chunk of their ACMS shares and buy back shares, or distribute a dividend, or they could sell a little bit and pay a small token dividend, or buy back a little bit of shares. The problem with sort of the share buyback idea is that, this is $1 billion company. It's not the most liquid thing out there. And so sometimes when it comes to share buybacks of, these very small companies, share buybacks don't work immediately, right? Oftentimes, it's a multi-year process. And so, making the shares more illiquid, for me, it just isn't as attractive as finding a way to sort of align the shareholder base with the underlying company, whether that's a sort of a take private at a premium and we list abroad, or pursue a Hong Kong listing, or sell the company. What's interesting here is that, oftentimes founder CEOs don't want to sell their companies because, to them, making a 30% pop and selling at a premium isn't as exciting. But here, if the company were to sell ACM Shanghai to AMEC or Nora, and allow AMEC Nora to continue consolidating within that sector and gain the number one cleaning business within China, shareholders make 600% returns overnight, or some, now it's less, but you're making a multi-bagger returns. And so, we would obviously be in favor of that as well. The other thing about the capital return is, I believe in many of those instances, if the capital return amount is relatively significant, you need approval from the Chinese government, and it's questionable whether they would receive that approval if it's merely to just return a chunk of cash back to holders, especially given that the government is so focused on having this company in this sector grow, and become as competitive as they can have it become.
There is also another thing where ACMS, the Shanghai sub, ACMR controls 82% of them, so it's pretty thin and illiquid. Like, how much do you think? There can be a lot of answers, right? ACMR can be undervalued and ACMS can be overvalued. The bus on valuation is so wide that the two can be true. It's just, how much do you think ACMS is overvalued, fair valued versus undervalued when you're kind of looking at that company saying, hey, it's pretty liquid. It does trade for a full multiple.
Yeah, I mean, I just think that like there's so much growth for these companies. I mean, ACMR has grown at north of 40% revenue growth, I believe, since 2018. I think it's like 6 years in a row, right? I mean, the growth is just very significant, and it's generating EBITDA margins of 20%. And I care less about even the margins today than just understanding that this is not one of those sectors, like EVs in China or solar panels in China, where suddenly there can be sort of 20 players eroding everyone's margins. Like you just sort of can't have 20 cleaning tool companies or 20 electrochemical plating tool companies because, you're not going to have YMTC or a SMIC have like, 6 different cleaning tools, within a fab. And so you've got attractive steady state margins, you've got significant growth. And so 6 times revenue multiple, 8 times revenue multiple seems very reasonable to me. So the arguments around those valuations being too high only sort of operate in the context that like, hey, it's China. Everything in China needs to be cheap, regardless of the business quality. Just because it's an asset in China, it shouldn't trade at 6 to 8 times revenue. But if you sort of take a step back from that and apply sort of a DCF, the multiples that the Chinese peers are trading at and ACMS is trading at are very defensible, in my opinion. And ACMS trades in line and actually at a small discount to its Chinese peers.
No, that's perfect. I mentioned it because I do think there would be, it's tough because it's a Shanghai listed company and you've got a US listed company, but there are interesting, what if ACMS starts buying the parent co, right? Like, hey, we'll give you $30 worth of ACMS shares. You can tender your ACMR shares into that. That creates a huge premium for an ACMR shareholder, but it also creates huge value for the remaining ACMR shareholders. And, you've kind of got the child buying the parent there is an interesting thing. Don't know if regulatory that's possible, but that seems to be one way that you could create a lot of value without some of the, as you said, selling the baby, right? Selling the baby to create a one-time pop, but missing it. You can comment on anything there, or I did have 1 or 2 last questions I wanted to ask you.
Yeah, whoever tries to tender for or buy, take private ACMR, whether it's the opco and some sort of creative acquisition there, or management teamed up with private equity, or even if it was one of the Chinese strategics trying to sort of bid for ACMR shares, ultimately just goes back to the fact that we'd probably receive an attractive premium because you sort of can't have a take underdone here based on my discussions with M&A lawyers by management. And then if it's purely a strategic and the CEO is selling all of the shares, then you
should be pretty aligned.
Yeah.
Yeah. Look, one of the things I think is interesting here, correct me if I'm wrong, but when I heard cleaning tools, it took me reading your report and like continued to read. For some reason, I just had in my hand like janitorial tools, and this is not that, but it's just really hard to get over cleaning tools being like not a commodity, low ROIC, like you can buy them off the shelf, but these are actually, they're cleaning things. I think the top line for ACMR cleans like things at the 19 nanometer level, and they're trying to get up to 15. So like that's, if I'm not mistaken, that's much smaller than your eye can see. So do you just want to talk about how like technically sophisticated a lot of the things that they do are? Because it's an interesting market. If I remember correctly, it's 5 to 8% of the cost of a fab is the cleaning tool. So it's a meaningful piece, but it's not so meaningful that the fabs want to take it in-house and do all this. So it is kind of in a really interesting niche there.
Yeah, so cleaning, so if you think of lithography as sort of at one end of the spectrum in terms of sophistication and sort of difficulty for Chinese companies to replace foreign tools, cleaning is more on the other side. It's sort of one of the less sophisticated tools out there. And so part of the diligence that we've done is tried to get the sense that, all right, well, ACMR is the number one provider of cleaning tools within China. But given that this is on the lesser sophisticated side, to what extent can they be replaced by other players, and can there be more competition in that space? And the sense that we've gotten is that even though it's not the most sophisticated, most advanced WFE sector or line of tools, that because they're in the pole position, it's still less likely that you're going to see a lot of competition there. And the competition would come from Nora, say. And the color we've gotten is just there's so much white space within China and so many tools for them to, try to bring in-house or bring to a sort of a domestic supplier away from foreign tool makers, that you're not seeing the multiple players sort of step on each other's toes and compete in the same area, rather within the Chinese players, there's not that much competition today, or really in the near to intermediate term. And so, the sense we've gotten from our channel checks is that they're likely to continue to be the number one player in cleaning, the number one player in ECP, electrochemical plating. And then they've got 4 other product lines. So they've got their third tool lines is in advanced packaging. And then they've brought out a furnace tool over the past year. They've been making shipments over the past year. You're going to start seeing some of that revenue in 2025. And then they've got a deposition tool on PECVD and a track tool. And within those other tools, again, they're not necessarily the most sophisticated tools or most advanced tools, but there doesn't seem to be as much competition for those tools. And so I think we're optimistic that they'll be able to put together a competitive tool, start getting market share, and grow within that. And so, I think that's sort of my answer to the idea that, hey, cleaning isn't the most advanced process step, should be concerned around that. And it just seems like, again, once you're in the fabs, the fabs just don't really want to rip out your tools and replace it with others.
You mentioned being long GLAM in 2022. Obviously, you are basically long semis, fabs here. About a few weeks ago, you have the deep research freak out where, they come out and everybody says, oh my God, these models, way less energy efficient, all this sort of stuff. And I think that's kind of really self-corrected in a really rapid pace. But I guess, how much are you exposed to you've laid out, hey, this is a secular winner because China is trying to insource and in-house all of this supply chain here. How much are you exposed to secular winner if there was a pause in AI spending or something and all these fabs kind of looked and said, hey, maybe we don't need to spend hundreds and hundreds of billions of dollars every year? Are these guys going to be affected by, I'm sure they'll be affected somewhat, but how affected by the bullet do kind of players like this become?
Yeah, so, there is some color coming out that overall WFE spending in China is slowing down, but it's difficult to separate how much of that decline is owing to foreign tools that were pre-purchased or that were sort of where there was advanced buying over the past couple of years in anticipation of future restrictions. How much of that slowdown in WFE spend is owing to those versus tools being sold by the Chinese tool makers? And it seems like the Chinese tool makers, there wasn't as much pre-buying, of those tools because, there's no forthcoming restrictions there. And then, offsetting sort of a slowdown in WFE spend is just them taking market share away from the foreign tools. And so, there's good Bernstein research out there on this. There's good Goldman research as well. But, Bernstein, I think, has that rate of localization, i.e. the percentage of a fab's tools that are Chinese versus non-Chinese, growing from mid-teens to the low 30s in the next 2 years. And so there's just a lot of displacement of foreign tools going on. And so that's driving growth, even in the absence of overall declines in WFE spend. And when we're talking about declines, I think the forecasts are declines of 5-10%. But I think even if you have 10 to 20%, the market share gains that the tool makers are making offsets, that growth offsets sort of the top level decline.
I think there was a lot of bear commentary around the company having a big buildup in particularly working capital over the past year to 18 months. And I think you guys had a different take on that. And I wanted to hit that, A, because you have a different take, And B, because, again, not accusing the company, but the first thing everyone looked for after you and so many people broke the ground on Chinese reverse merger frauds was, hey, what's the working capital look like? Why does this $500 million company have $17 billion in inventory or something? So just wanted to address the working capital because I thought y'all had a very differentiated take on it.
Yeah, I mean, look, we would love to have, if there's positive net income, to have positive cash flow. But, this just isn't one of those types of businesses because of just sort of the type of business it is. So, when they're selling a tool into a fab, there's customization that needs to go into that tool. So whether you're selling a cleaning tool to a logic fab or a memory fab, there's a variety of customizations that need to be done. And this is a fast growing company. So they're selling a lot of first tools into these fabs. And that's great. For the long-term story, you're getting a foothold into all of these SOE fabs, and then there's sort of a land and expand model where you're in there with cleaning, and then you go in with your furnace product and your tool and your track product. But their disclosures in their K, which just sort of resonates with what you would think intuitively, is that the first tools that they ship, there's a lengthy evaluation period that they say is anywhere up to 24 months, and that they're not necessarily receiving payment until after those 24 months. And so if you're growing 40% a year for the past, going from nothing to $1 billion of revenue, you're selling a lot of first tools into a lot of fabs, and you're not getting paid out on those first tools until 2 years later. And on the revenue recognition side, there's sort of this delayed revenue recognition where they don't recognize the revenue of first tools for a while, whereas they recognize revenue of repeat tools on shipment and delivery. And so the result is when you look at the cash flow statement, you're seeing a lot of negative working capital on the inventory side, and you're seeing the inventory days sales outstanding, or the inventory days outstanding north of 500 days, which is a big number. In the report, we talk about how ultimately you should see some of this cash flow coming in over the next few years as more of the tools that they're shipping are transitioning from first tools as a percentage of the total tools to repeat tools. Hopefully, that'll happen. But sort of again, the big picture thing that's gotten us comfortable around the working capital here is the channel checks that are coming back on the competitiveness of their tools. If the tools are going into the fabs and you're seeing, your channel checks are coming back saying that, they're attractive to the customers, one way or another, ultimately they're going to get paid, I would think. And so that's sort of my best answer on the working capital.
Famous last words, will ultimately get paid, we think. This podcast is sponsored by AlphaSense. If you're unfamiliar with AlphaSense, it's a market intelligence platform with the world's premier library of proprietary expert insights. For years now, I've used Tegus for their expert call transcript and library. And with AlphaSense acquisition, the depth and breadth of market research content available has expanded significantly. With unparalleled expert insights across 150,000 proprietary expert transcripts and growing by 6,000 per month, covering 24,000 public and private companies, comprehensive market intelligence on 450 million plus documents, including company filings, analyst research, expert interviews, and more, and AI-powered research at scale, complete with qualitative research for 5 to 10x faster with advanced generative AI. Take a free trial and see the difference for yourself. Just go to alphasense.com/YAVP. That's alpha-sense.com/YAVP, or see the link in the show notes. I think we've hit most of the bullet points from your research. Again, I'll include a link to the paper in the show notes if anybody wants to go dive deeper. I think we've hit most of the bullet points, but is there anything kind of you came on here wanting to talk about that you think we should have hit a little harder?
Yeah, I mean, I think this is a sort of a smaller cap company, and so the role that we can have here is, educate the market that the business is actually operating well. I mean, people can look at the financial statements and they can understand sort of the valuation and the growth. But, because it's in China, because it's a semi-cap company and it's only $1 billion market cap, there's not as much color out there of sort of independent observers verifying that, their tools are competitive. And so we're hoping by sort of packaging that all in a report, we can get people a little bit more comfortable with the underlying operating story. And, sometimes when you look at some of these smaller companies, people are just like, oh, it's just too much work, to sort of source experts that know about the semi sector in China, and sort of buy into this operating story, and hopefully provide some color on that.
You published this, and you published it before we decided to do the podcast. And I was like, what the fudge are these guys looking at? Like a Chinese semiconductor? And one of my friends said, it's levered torque to the Chinese semiconductor industry. And I thought that was a negative thing. And I was like, these guys, like, this is a YOLO beta bet. But as you laid out, as some people have laid out, like, yes, there is risk there, but that's a really nice place to be when the Chinese the government is encouraging everything to be locally sourced. Like, it's really nice to be levered torque on that local sourcing. So, I am definitely with you. And then it's very difficult to do if you're an outsider, a non-specialist, you hear that and you're like, oh my God. But once you've laid it out, or you really buy into it, I think. And then also I just, me in a special situation. I love that you've got the U.S. parent co trading at $1 billion and the hold co, or the operating co, trading at $6 billion. There's you can drive a truck through that valuation. That seems to give you a pretty large degree of safety if you can get comfy with a lot of stuff. Last question I wanted to ask you. Look, there are certainly risks here. There are cycle risks. There's government risks. I think we've done a nice job discussing them all. But if I said, hey, you're invested in this thing for your disclosures make very clear it could be the next 30 seconds of the next 30 months. But if I said, hey, you own this thing, what's the risk that keeps you up at night when you think about the stock? Is it the governance, the angles? Is it just the pure macroeconomics of it? What kind of keeps you up the most here?
Yeah, I mean, I think it's the overhang of, what the U.S. government could potentially do. I think this is a small name, and it's hard to think of a company this small, making it onto the radar of the U.S. government. But it's listed in a country that wants to limit the growth of its sector and its business, and so who knows, right?
Are you worried about a Russia situation where the whole firm gets sanctioned, and even though they own the vast majority of the Chinese sub, they can't get any value for it because the U.S. government says, hey, even though you own that, let's cut off our nose to spite our face. You can't access that money or do anything with it?
Yeah, I mean, sure. Any sort of iteration of that,
okay.
Right? On that, one of the things that I sort of do address here and there is that the U.S. government does have a list where it can add certain companies to that list and restrict U.S. ownership of U.S. persons' ownership of those companies. But what's interesting here is that you would have 365 days. So that regulation, I think the list is the NSCMIC list or whatever it is. U.S. shareholders have 365 days before they have to divest. And, what I find interesting about that is it could accelerate the listing in Hong Kong. And so then you sort of create dual listing in Hong Kong, and you organize a corporate action where U.S. shareholders convert their shares into Hong Kong. And then once you've got all the shares in Hong Kong, I just don't think you're going to have the Hong Kong hold trade at a 68% discount. I think that discount narrows to 10 to 25% relatively quickly. So in a way, it actually could be a catalyst for the upside. But I think, outside of that specific list, and it's just, you've never had a U.S. company owned by a U.S. passport holder be added to that list, especially one of this size. So, I think it's a very tail risk that's unlikely to happen.
I think the government's also realized, with Venezuela bonds and stuff, it's like, hey, U.S. investors cannot own Venezuela bonds. Cool. You force U.S. investors to panic sell their Venezuelan bonds, so they take huge losses. The bond still exists. It's not like you've stopped Venezuela from doing anything. Now, you could say U.S. investors can't buy new issue Venezuelan bonds and stuff that's different. But going to U.S. companies saying, hey, you can't own this Chinese assets, cool. You have harmed U.S. shareholders, and the assets are still over there in China. Like you've done absolutely nothing. So I think it's both.
Yeah, I think like China
policy.
Mobile's at all-time highs now. CNOOC is at all-time highs. Those were companies that were added to the list. Ultimately there'll be new buyers. So yeah, to your point, sort of was never really an effective policy. And
I think it's bad policy as well as a tail risk. Well, this has been great. Again, I'm going to include a link to Kerrisdale's write-up. It's about 30 pages. It's very well researched, very in depth. I think if people are interested in it, they should do it. And anytime you have a long idea, you're welcome to come on this podcast and pitch it because they're well researched. I know it's rare for you guys. No short ideas. I don't need any of that legal risk, but any long ideas, you have an open invite on here.
Sounds great. Yeah, thanks so much for having me on.
Thanks again for coming on. A quick disclaimer, nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.